that everyone is able to join us. Tonight's session should be fun. It's just going to be us. Tawana, unfortunately, had another commitment, so she is not able to be here tonight. So I have some stuff to go over. I went to a place called Angel University, and we are going to talk about 13 of the lessons that I learned from Angel University. And then if we have extra time, I want to hear from all of you today. So don't forget to put your city and state in the chat as you are coming in. Thank you so much. We are officially live streaming on Facebook, and we are officially on YouTube as well. I see everybody out here, so I want to say hello. Hello to everybody. Okay. We have in the house, we have Kansas City, Missouri. We've got Memphis, Jonesboro, Georgia, Charlotte, North Carolina, Montgomery, Alabama, Brooklyn, New York. Hello, hello, everybody. Memphis, Tennessee. Denise, a hearty hello to you too. We've got Bowie in the house. Hi. Hope everyone's doing well tonight. Hope you all are enjoying your summer. Summer is almost over. Some of you, hopefully most of you, the kids are going back to school, but I know things are still kind of up in the air. So some of us are wondering if we're still going back to the office and all of that. But tonight's conversation is all about wealth building in the 10K community. So I see Dallas in the house. I see Owings Mills in the house. Hello, everybody, and welcome. School began today in Memphis. Wow, wow. Must be a totally different world for the students and the parents then. Definitely. So I'm going to get started. Thank you so much, everyone, for being here. I see Queens in the house. Welcome. We are the 10K Project. We're the largest community of small dollar investors who actively fund Black-owned businesses. So the minimum investment is $100 every Tuesday at 8 p.m. Eastern Time. We host something called a Bet on Black pitch. And what happens is we invite an entrepreneur, a Black entrepreneur, to come to our community in order to tell us about their business, give us a presentation about their company, and each individual person on that line that's listening to that pitch can decide if he or she wants to invest in that business. So minimum investment is usually $100. We get everything from Super Bowl champion last week with an engineering product. We get tech, we get, high tech, low tech, all sorts of businesses in there. And it's a really great way for you to, number one, help Black businesses. Number two, we can own pieces of our own businesses because we invest in exchange for equity or shares in those businesses. And number three, we are able to also do group economics and expand the Black community and, stretch out the time that the Black dollar is held within the community. So if you are looking to be a part of the 10K Project, it is a one-time payment of $100. That is our basic membership package. We have our Knowledge Center, which we have so much content in there: how to invest in hotels, tax liens, debt, all sorts of financial literacy is in the Knowledge Center. You're also able to come to the Bet on Black pitches. You're able to add yourself to the expert directory. So if these companies or anybody is looking for your service, whether you're a CPA, graphic designer, writer, contractor, whatever you are, you're able to put yourself in that expert directory. And then if you also want 6 months of a customized, personalized financial coaching, you are able to upgrade to the 347 package. And we have partnered with Freeman Capital in order to provide 6 months of financial planning. That usually is, I think, about $900 value that you're getting for 347. So, hey, Tawana, DMV, good to see you. All righty then. So again, I would encourage you, the10kproject.com, the10kproject.com, if you want to be a part of the 10K Project community. Tawana also asked me to make sure all of you know that tomorrow night we have a cryptocurrency project coming, crypto. So if you are interested, and sometimes, you hear things like that and you're like, oh, I don't think I would be interested in something like that. I always tell people show up, because you think one thing when you're entering the pitch, and then by the end of the pitch, you learn about a whole new industry, you learn about a whole new market opportunity, et cetera. So I definitely encourage everybody to be in the building. Be in the building. Okay, then. So tonight's session is all about this place on Zoom that I went called Angel University. And it is run by a guy named Jason Calacanis. Oh, I left his book upstairs, but he took, I think, $1 million and turned it into $100 million or something like that. He calls himself the GOAT of angel investing, currently the GOAT of angel investing. I think a couple of weeks ago, we did a broadcast where we broke down an interview that he did, but every 6 months, he has this thing called Angel University, where he trains people how to become either better angel investors, which is what we are within the 10K project, or, he does have a syndicate as well, but you've got to have some dollars in order to be a part of that. But there are some great lessons. And tonight, there are 13 lessons that I learned from Angel U that I really wanted to share with you today. I think that these lessons are all around just great lessons within how to invest as an angel investor. As you're listening to the Bet on Black pitches, as you are talking with the founders, as you're doing your research, and it gets us in the frame of mind of these companies or these individuals that are doing 40 to 50% ROI. We often hear the rich get richer in this country, and this is one of the reasons why. So it's a great way for me to tap into the lessons that they're telling each other, and having conversations amongst each other with regards to this. So y'all know I prepped a little presentation, and this is just to keep me on track. So I'm gonna share my screen here. And this is an excellent opportunity for you to get your pens and papers out as we talk about Angel University and the 13 lessons I learned from Angel University. So lesson number 1 is it takes a long time to determine if your investment is successful, but failure comes quickly. Unlike other asset classes, you get negative reinforcement, but sticking to it requires a leap of faith. So what does this mean? Within the types of investing that we're doing, if a company, for example, is a brand new startup, they have not made any money thus far, they have not created their uh, beta pilot program, they don't have a prototype, you discover fairly quickly that that investment did not work for you. However, if a company becomes a unicorn, for example, Robinhood um, became public a couple of weeks ago, and we talked about the fact that Snoop and Nas invested in Robinhood back in 2014, and it's 2021 before they discovered that this was going to be a successful investment for them. The average angel investor knows that their failures are going to show up quickly and their successes are going to take 7 to 10 years to show up. So this is kind of like, long-term health habits. For example, we just have to be prepared to build a portfolio and be prepared that when we see the losses come, because they do, if you're building a portfolio, for us to not get shaken up by it. Lesson number 2, deal flow. Deal flow is the key. What is deal flow? It's being able to find and hear about the investment opportunities that are out there. These professional investors are like, it's everything. The types of projects that are presented to them is everything. It really is. And it's actually quite competitive. And our entrepreneurs right now, I'm going to say, are not as competitive because they don't have access, but this is quickly starting to change, which is why we want as many Black people as possible to get involved with the 10K project and start investing in these companies, because I believe there may come a time where these successful angel investors are really, really going to start seeking out our businesses. Calendly is a great example. There are examples of our entrepreneurs that are starting to actually become unicorns. And once that happens and people from the dominant society, I'll just say, begin to see that we are able to bring unicorns to the marketplace, then they're really going to get involved with looking for Black and Hispanic entrepreneurs more actively than they are right now. So deal flow for them is very key. The value of your portfolio is dependent on the types and numbers of deals that you can access. And what they do again is they build a portfolio. Lesson number 3, we need to explain to founders, this is we as angel investors need to explain to founders why they should take our money and what else we can offer within their journey. And again, this is a lesson from Angel University. These are angel investors that are teaching other angels that it's not just about the money that we bring to the table, it's about the other things that we can offer as well, which is why, hint, hint, that expert directory is so important. It's why we don't want to just be investors. If you really like that product, you should always also be a consumer. You may also want to tell people on your social media. We have sometimes more value to these entrepreneurs than some of the professional angel investors do that can write them $150,000, $250,000 check. And that's where we can really shine within the 10K project. Lesson number 4, being able to give an entrepreneur $25,000 if they are seeking, for example, $1 million, can be life-changing for the entrepreneur, especially if we can do it immediately. So that's where we're growing the membership. That's why we're texting you, a couple of times saying, hey, the Bet on Black pitches, on Tuesdays at 8. That's the reason why we're talking up the entrepreneurs that are coming to the platform. I believe that we'll get to a point, we can do this, where we can raise $1 million to $5 million for an entrepreneur within 24 hours. We get to that point, we'll be unstoppable. Going back to lesson number 2 about the deal flow, the deals will really, really start coming to us. Lesson number 5, there will be times when a company doesn't make it. And again, these angel investors are saying that they keep it classy no matter what. They don't blow up at the entrepreneur, they don't call them incessantly, things like that. They understand how to handle an entrepreneur that is going out of business, especially if they're a good entrepreneur. Because these entrepreneurs typically will have 4 companies in their lifetimes, and one of them may be Uber. So if you find a good entrepreneur, if we find a good entrepreneur, it's best for us to keep in touch with them and keep funding them. In fact, there's an author I'm trying to get to come who has a book called Super Founders. And I listened to we call it, an interview with him. And he said that most entrepreneurs that have a unicorn have a small success before they have that unicorn. It's very rare that you see a Mark Zuckerberg that has a unicorn, basically the first company he comes out with. That's extremely rare. Most successful unicorn founding companies, the entrepreneur has a small success beforehand, and the angel investors that make it, they stick with that entrepreneur because they know the next time he may hit an Uber, a Robinhood, something that becomes really, really big. Lesson number 6, the CEO, and feel free to ask questions as well within the chat here. The CEO of Y Combinator said things like, I'm not in this to make money. Y Combinator is a very, very, very well-known accelerator, okay? The CEO, though, said, I'm not doing this to make money. But this is really bad advice, according to Angel University. You want the entrepreneur to know that you are in this to make money and that you want both the entrepreneur and you to make money. We, as angel investors, should be thinking about being so successful with our investing that it has generational effects. And this is not me saying this, this was Jason saying this, okay? Jason wants to be a full-time angel investor with extraordinary returns. He's already a full-time angel investor, but he wants to have extraordinary returns. He wants to be that good. Lesson number 7, I thought this one was interesting. A person who is 40 years old is 15 times more likely to find a successful startup as a person who is 20. Among the 2.7 million founders in their data set, the average age of a company's founder at the time the company was founded was 41.9 years of age. And this is actually confirmed in that book, Startup Founders, where we're going to actually go through the data of what these billion-dollar companies look like when they get started. But this is interesting. So everybody, this little audience participation time, if you're between the ages of, let's say, 38 and 50, I want you to put a 1 in the chat. If you're between the ages of 38 and 50, put a 1 in the chat for me. All right, I'm seeing the 1s come through. That means that we have a better chance of success with funding your company. It's not too late. Because sometimes we think we're 45 and it's too late. No, it isn't. It isn't, looking at this. But I also want to say, if you're 25, jump in. You may have that first success that we need to see so that by the time you are 38, that's when we'll see the second big success come through. I also believe, and you all can let me know what you think in the chat. I also believe that 40, you have number 1, life experience, and number 2, oftentimes you do have a family as well at that point. And when you have a family, you don't have the luxury of just giving up whenever you want to give up. You actually do have to say, hold on, wait, I need to, you know, stick with this longer. You can let me know what you think. Um, Tanya's asking, will some of the companies offer dividends? That is on a company by company basis. So what you do within the Bet on Black pitch, and that's a great question, Tanya. What you do within the Bet on Black pitch is you ask the companies, how are you going to get your money back? And they usually tell us within the presentations, and you're able to decide based on everything they told you if you're going to invest in that company. Lesson number 8. They want a potential of $100 million in revenue. And they're saying not valuation, but revenue. So the way the valuation works is that they're basically 10xing revenue in order to get to valuation of $1 billion. So one of the things that they ask founders to do is explain how the founder will get $100 million in revenue. Now, for our businesses, we don't necessarily have to have this hard and fast rule. For our businesses, everybody has their own portfolio within the 10K project. We always say that. But you may say, you know what, I only want to invest in companies that have a potential of reaching 50 million in revenue or 20 million in revenue, et cetera. But one of the reasons why Jason and his team have such a high success as they do is because everything that they put into their deal basket and everything they invest in are companies that have a path to $100 million. Now, again, in the Startup Founders book that we're going to review next month, I'm going to break down a little bit more about how you can tell if these companies are going to be $100 million companies plus, because again, they've done statistical research with regards to this. But I will also say this as well. We know our companies are different. So we just are understanding these lessons so that we can get into their heads, so that we can understand what we can do better. But by no means am I saying that we as a people, we as a 10K project should follow their lessons 100%. Okay, number 9. Most companies, about 80% of companies, die between idea and paid pilots. And this is a part of life. Most companies die between idea and, I'm just going to say, revenue. So someone has a great idea. They think there's going to be something called product market fit. It doesn't exactly work. That's a part of the process. So some people may say, I will only invest in companies that are generating revenue. Some people may say, I will only invest in companies that's generating a certain amount of revenue. Some people may say, if you have enough money, I'll invest in these smaller companies that are still in the ideation phase but I'm only going to put a super small amount of my investment assets into these types of companies. And going back to number 9, Snoop and Nas invested in Series A, and they invested just before the beta pilot happened. But the difference between them and some others is they had 450,000 people that wanted to be a part of the pilot. So in my opinion, they did have eager customers that wanted to be a part of that business. Okay, lesson number 10. Patents don't generally come up in angel investing, especially on the West Coast. Most companies do not succeed because of a patent or solely because of a patent. I've heard this before. I've heard Mark Cuban from Shark Tank talk about this. He, says, I don't care if a company has a patent. There are other people who feel like, I don't care if a company has a patent. Some investors really do care if there's intellectual property that it is protected. One of the things that's my understanding with patents is there was a time when it was difficult to breach a patent because there had to be a 35% difference between whatever was patented and the new idea. And my understanding is those requirements have changed and now it's like 10% difference. Well, anybody can make a 10% difference. So one of the things that came up last week with the Super Bowl champion and that company is they not only have their primary patent, but they're having patents built all around that primary patent so that no one can breach that initial patent. Does anyone remember that? Put it two in the chat if you kind of remember that conversation last week with the Super Bowl champion and how they have a patent and then they're going to have patents that are like all around the patent to build it up as a fortress. Yes. Okay. So you all remember that. That's the reason why they're doing this, which I think it's smart for that company. I'll say that. So, not investment advice. Don't read into it. Um, okay, number 11. The likelihood of return increases exponentially with a minimum of 25 investments to get enough so that you can have enough of a probability of success. So it's better to have 50 investments, and 100 investments are even better. So we've always talked, Juan and I have always talked about the fact that you want to build a portfolio. The best chance of you having success with this type of investment is to have a portfolio. And I believe I told the story a couple of times. If you all are new, I'm a business plan writer. That's my full-time trade and business. And I speak with a lot of angel investors. And one of them told me one time, out of every 10 companies that she invests in, she expects 6 to fail, 3 to just give her a return, and 1 to be super successful. She goes in believing all 10 will be super successful, but the odds are just the odds. That is just the way that it works within angel investor field. And everyone else that I've spoken to has pretty much said the same thing. So Jason is saying the same thing. He's saying that, you have to build a portfolio in order to have the best chances of success. Lesson number 12. Oh, let me go back to lesson number 11 because I have a couple of other things here. So Jason has a return of 52.65% for his portfolio. He has a return of 52.65% on his portfolio. And he says you don't have to have a unicorn in order to do well. Those are two other things he said with regards to building this portfolio. Alrighty then, lesson number 12. And I think we talked about this before briefly. You get to write off the losers against your capital gains. See, the rich are getting richer. They even put it into the tax code, people. CYA, check with your accountant. CYA, check with your accountant. But you know that there's going to be a certain number of businesses that are not going to make it. And they actually keep track of the businesses that do make it, but more importantly, the businesses that don't, and they write off the losses. Sometimes they say that you may get a letter or potentially even an email from the company, you can bring that to your CPA. They say that they do not get K1s. I know some of you are familiar with getting K1s. They do not get K1s if the company goes out of business. But some sort of way they try to prove that the company has gone out of business. And from there, they, keep copious records. That's one of the big things with any kind of investment and any kind of wealth building that we're doing. And lesson number 13 is don't invest in a sales pitch, invest in traction. Don't invest in a sales pitch, invest in traction. That's the 13 lessons that I got from Angel University. I'm going to get back into Facebook and see if people have questions. I see Mr. Leisure here. I see S. Coleman. Don't forget, yes, to like the video if you were on YouTube or Facebook. Don't forget to share as well. So y'all are my co-hosts for today. What I would love to do is have some people agree to come on and tell me what what you learned from those 13 lessons. I will not put you on video, so don't worry. You'll just be audio only. But if you could raise your hand, let me know that you're willing to come on. I'd love to know what lesson, was something that maybe you didn't know or something that's reinforced, etc. And you all got the short version. That Angel University was three and a half hours. I'm like, oh my gosh. All right, Kiara.
So I just unmute myself and that's all.
Yeah, I can hear you. You're loud and clear. Hi.
Hey. Well, one thing that really resonated with me was to invest in traction and not a sales pitch. And why that stuck out to me was not that long ago, I was living in San Francisco and I was in one of those startup houses with investors and a bunch of founders living together. And there was this one robotics company that was operating out of the garage that built these robots that like made smoothies, and it had a robot that like served them to you. And they raised millions of dollars and hired a big team, and they hadn't even sold one unit. And then they went out of business before they even finished building the robotic smoothie machine that was in the garage. So then they had this halfway built thing in the garage, and I'm like, wow, these people really raised all that money. And the only startup in the house that actually went on to make sales actually didn't get any investment because it wasn't, it didn't sound as exciting. But they were making
sexy.
Yeah, it wasn't sexy.
Yeah, and there are a lot of us out here who, are on the business side of everything. And the non-sexy businesses that cash flow, they always make the most money. Yeah, and sometimes the robotics things and the things that we think are, so cutting edge, sometimes they're too far ahead of their time as well. So, you want to think sometimes, again, I think that everyone should have their own criteria for the investments that they make. But one of the things I try to do is ask, okay, is this thing the next logical step in progression for people? So I have to admit, if somebody came to me 10 years ago and said, hey, do you want to invest in SpaceX? I'd kind of be like, I don't think so. Even though Jeff Bezos and whomever else, Elon Musk are making money or starting to make money now. Yeah, what Kiara is saying is so important, that sometimes it's the things that look dull that are actually the real money makers. Did you have anything else, Kiara?
I guess another thing that I would say is just about diversification.
Hmm.
Um, like it can be really easy, especially with these portals like WeFunder, to find something that's super exciting and like throw all your money at it. But especially if you're not an accredited investor, you can only invest so much money. And so, like, one thing that I've been doing is trying to think, like, okay, if I can only invest X amount of money in X amount of time, then how do I diversify my portfolio in a way that I have the best chances instead of just getting super excited about one company and then they like, if they fall on their face, then I just lost everything.
Yeah, I agree with that as well. I personally have an amount that I try to put into every business that I invest in equally. And that way I kind of take some of the emotion out of it. And it's a little funny, so I'll tell you a little bit. There are a couple of investments that I got excited about that when I got to the page, I'm like, but this is over the amount of money that I put into any single investment. And that's one of my investment decisions. We talk about due diligence and don't diligence all the time. And I think, it's important for us to have investment rules and stick to them. Or if there's a reason that we're breaking them, really think about this is the reason that I'm breaking the rule for this company. So, does anybody else have any comments? In YouTube, I can see you in YouTube. So if you have a comment, I can read it out. Just put it in the chat. Everybody in Zoom, just raise your hand. Again, you're not going to be on camera. All righty then. We're going to bring on Charlotte. Hello, Charlotte. You have to unmute yourself. Yeah.
Yes.
Hey.
Hi there. So I think one of the great things that you said today was not to invest in the sales pitch. Because I think you are very much attracted to maybe the charismatic nature of someone and how it sounds like a great thing to do or what have you. But then when you think about how many pieces and parts may be moving, I thought about that recently about something that was shown on um, the Bet on Back pitch, that there just seemed like there were so many pieces though. It sounded like a great idea, seemed innovative, but so I think just not getting sucked into the sales pitch, but really thinking about what is the likelihood that this is really going to gain traction. So I thought that was
Yeah.
really good.
Yeah, that seems to be sticking with a lot of people. So thank you, Charlotte. Anything else? Was there another lesson that you liked?
Um, No, I think that one is the one that kind of stuck with me because I am sort of new. I've been
Okay.
listening to the 10K on Monday, but so for
Okay.
me, although I've been investing through my broker for a long time, this is the first time that they've given me money to dabble with. So I'm having to pay close attention now that
Yes.
I'm the one making the decisions.
Yeah, look, it's a whole new world out here, definitely. And it's a different asset class as well. So there are, um, I think there are new things that we're being exposed to. And um, the best thing is diversification, no matter what. So I agree. Anything else? Any final words?
No, other than to say how I certainly appreciate my fellow friends who invited me to be here. And so I'm not going to keep it just to myself. I'm spreading the word too.
Thank you so much. We appreciate it. And we are growing steadily every week. So we appreciate you. Um, Okay, who else wants to speak? Don't forget to raise your hand. If you are in YouTube, you can put something in the chat. I can see it. Anybody else want to talk about a lesson that really stuck with them? What do you all think about the fact that I'm going to pull a couple of these out? My favorite, or one of my favorites, is that people who are 40 are 50 times more like, sorry, 15, 15 times more likely to find or found, be a founder of a successful startup than someone who is 20. What do you all think about that one? Anybody who wants to talk, just raise your hand. It's one of my favorites. Yes, Kiara.
Um, so one thing that I thought was really interesting about that was I was talking to this guy who's actually a Black man, and he's considered the most successful angel investor in Central Texas because startups that he picks, he's able to analyze them in such a way that most of them tend to be successful. And he was saying that he won't invest in anybody over the age of 25, I think. And
okay, why? All right.
Even when he was saying that like years ago, and I heard him say that, I was like, well, that seems kind of arcane. I mean, obviously he's better at this than I am, but it's just like, I think that people assume that you're going to get tied up with family and kids. And maybe there's this notion out there that like, once you have kids, your life is over, especially for women. It's like, oh, well, if a person is like a parent, then like that's all they're going to be or whatever. But honestly, I could really see how that experience could make somebody more rational, more level-headed. I mentioned briefly that I was coming from the Bay Area, and I was very much part of the startup scene there. And I saw a lot of like young dudes get all this money and they just blow it. Like they'd spend it on all kinds of ridiculous stuff. And I don't know. I can see like it makes rational sense that somebody who's more advanced in their career, who's seen many things, would be more successful. But I've also met a lot of investors who will not invest in somebody that's past their mid-20s. So they're probably missing out, I guess.
Well, the data actually says that they're missing out. And again, it's not just Jason's data set, even though they may have gotten the same data set, but it's also this guy that wrote this book called Super Founders. And it's all the data that he collected with regards to the top companies that are out there and what data points they had when they got started and early on in their careers. So yeah, John, welcome.
Yes,
John.
thank you.
Hey, yes.
Thank you. Yeah, hi. Yeah, I actually, that point about age and generational relationship to success was one of my key takeaways. It was one of the points that stood out to me most. Basically, I think what it said is that experience matters. It says experience matters. Anyway, it's not exclusive, and it's not the only exclusive success factor. But it's just as it would be just as I think closed-minded and to some degree simplistic to say that experience alone matters, as it is to go to the opposite point of what's going on. I think too often today, where the presumption is that youth matters more. Youth is the key golden, that's the secret sauce to success in a startup. And I think it's born from this this notion of this kind of super young charismatic, or maybe not even charismatic, maybe actually sort of anti-charismatic, but super nerdy kind of dropout stereotype that comes from, a couple of high-profile examples in Silicon Valley ecosystem. And yeah, there are examples like Bill Gates, and there are examples, Steve Jobs and Wozniak when they were younger, and there's examples, of course, like Zuckerberg, and you see, but those were primarily, I think, they were primarily the function of, more recently, the phenomenon of profiling that Silicon Valley admittedly engaged in since the late 90s till today. And that profiling basically is a fancy term for, I hate to say it, but stereotype and discrimination. And what it means is that what they call it profiling is that they consider it a good thing, and they've referred to it, proudly as basically what they think is rational. Well, they consider it to be rational decision making in selecting their founders, meaning that they basically say, let's look at who was successful before, and we'll narrow our focus to that same demographic of success previously, as it's for focusing our future investments on that, to increase the chance of success. And what that's as ignorant as saying, all right, we drilled for oil in this one spot, and we've been drilling for it. We're just taking all the oil out of this one, let's say, piece of land in Texas or Oklahoma. We're just going to stick to this area drilling for oil in the future, as opposed to, all right, well, yeah, there's oil here, but there's a limited amount here. There's oil probably unexplored other places, and that's the same thing I think that 10K is addressing, is that you've neglected the full.
Yeah.
Go ahead.
So there's been proof that Black entrepreneurs, Hispanic entrepreneurs, and also female entrepreneurs, they are not given the chances. They're not given the funding. And when they go into these meetings with these high profile investors, they said, well, we've never seen a woman do that before, so we don't think you can do it. We've never seen a Black person do that before, so we don't think you can do it. And I've heard this personally and through interviews with Black founders and female founders. And this is why I keep trying to tell everybody who's listening here, get into 10K or some version of it while you can, because the minute they see Calendly was started by a Black man, is super successful. There are people who are up and coming. Once these high profile angel investors start seeing that Black people can do it, the floodgates are going to open for them. And it may be harder for us to get in at those times. Right. So that's why we've got to be the place where they know they can come now to raise their millions, so that when this happens, they're like, oh no, but we still want to work with the 10K project, or, if somebody else has another version of 10K, great. I would love for us to be the place, just because I feel like it's important for us to all be congregated in one place where we make such an impact that people can't help but see us,
Right.
Yeah. I agree with you.
Exactly.
So Jeffrey in the chat is saying none of those myths and hyperbole is applicable to Black entrepreneurs, because youth is just another layer of discrimination for non-Black investors. So we also have to think about Bill Gates and Mark Zuckerberg and the type of life that they had before they got a whole bunch of money invested in them versus our youth, and I hate to put it like that, but y'all understand what I'm trying to say. We're seen as different, even if we went to one of the best schools, we're just seen as different. So so John, do you have anything else?
No, I'll let certainly let other folks join in and give their opinion. But I think it's I think you raised a lot of good points and a lot of good nuggets of wisdom there.
Well, thank you. Thank you so much. And definitely, we have another 10 minutes. So if I bring something else up, just feel free to hop back in. Arthur is saying off topic, but I've been having trouble upgrading my membership. If you email me info@the10kproject.com, info@the10kproject.com, we have gotten that straightened out, but I need to send you the directions, or anybody else who wants to upgrade their membership. info@the10kproject.com, please. Mario in YouTube is saying we have the best of both worlds, disposable income and experience. We've dealt with failures and comebacks many times over. S. Coleman is saying, my thinking would be someone younger would be more fearless than an older person. Change is harder because of expectations and experiences. So yes, a younger person may be more fearless, but sometimes there's an area of business called risk analysis and risk management. And one of the sharks, Kevin O'Leary did an analysis of all of the businesses that he has ever funded. And you know what the number one entrepreneur type was that always provided returns for him? Were his female entrepreneurs. He said his most successful couple of entrepreneurs were men, but of everybody else who was given a real return on investment, it were the females. And he said he dug a little bit deeper to figure out why these female entrepreneurs were so successful. And he said it was a true mixture of they would swing the bat, they would consistently hit singles, doubles. They weren't necessarily home run type of businesses, but they did a fair amount of risk assessment on every decision that was made. So I do think you will have the Facebooks, for example, the Zuckerbergs, et cetera. But if you're looking at 100 companies, that may be 2 or 3 out of 100. So, when we study the Super Founders book with all of the data sets, which I think will be very interesting for us, for all the nerds in us next month, the second Monday in September is when we're going to have that discussion. I think that we'll discover some more interesting pieces of content in there. So, yeah, so that is the session for today, unless, Charlotte, did you want to come back on and talk about the 40-year-olds being more successful, 15 times more successful than the 20-year-olds? I thought I saw you unmute yourself. Okay. So Jeffrey is saying here, our focus should be on excellence and let that resonate, transcend, and overwhelm discrimination, naysayers, and skeptics, and find every possible way to maximize direct to market or consumer opportunities when possible. Yeah, absolutely. And I think that within our community, success will come in all ages. Some people will be ADOS, descendants of slaves, American descendants of slaves. Some people will be Caribbean, some people will be African. Some people will be male, female, young, older. Some will be family businesses. Some will be, solo entrepreneurs, etc. So it'll be interesting in the next 10 years. Maybe we'll have our own data sets. Chris is asking if we have the numbers for 50 and older. No, we don't, unfortunately. It may be in that Super Founders book, so I'll look through that. And when we come back next month, we'll talk about it. Okay, everybody. Well, this is going to be the end of tonight's session. So again, if you are not a member, the10kproject.com, the10kproject.com. Otherwise, we'll see you tomorrow night, 8 p.m. For the Bet on Black Pitch. That's 8 p.m. Eastern time. For the Bet on Black Pitch, it's a cryptocurrency industry business for tomorrow night. Okay, everybody, take care.